Hello, my name is Greg Medcraft, the OECD's Director for Financial and Enterprise Affairs, speaking to you from Paris. The COVID-19 pandemic is having serious economic effects, and financial markets are facing their biggest challenge since the global financial crisis in 2008. In this video, I'm going to firstly highlight where the fragilities in the financial system are, including the key difference in the financial markets between now and the 2008 crisis. Understanding these is critical to understanding the current challenge. Secondly, underline what governments should be doing in response. My message here is that a coordinated policy response is needed from governments, central banks, and regulatory agencies. And they need to go hard and fast to stop potentially a vicious cycle taking hold in markets. First, on fragilities in the financial system. It's important to realize that the challenges and vulnerabilities are very different to the global financial crisis in 2008. Then, as now, large amounts of debt form the main fault lines in financial markets. But in 2008, that debt was largely held by financial institutions. Today, it's overwhelmingly held by businesses and governments. This chart shows how the issuance of corporate bonds has grown rapidly in recent years. It's doubled since 2008 to US 14 trillion of outstanding debt. These bonds are a type of debt issued over a set period where the original amount is paid back at the end of the period along with regular interest payments over that time. Here we see that the quality of corporate bonds has declined over time as measured by their credit ratings. These ratings represent the likelihood or the risk that a company will default on their interest or principal repayments. AAA ratings, the highest rating of quality with the lowest level of risk, has been declining as a share of all bonds issued. While BBB, the riskiest grade before a bond is considered high risk or a junk bond, has risen. Over 50% of outstanding corporate bonds are now BBB rated. These bonds are at the cliff edge of investment grade and very vulnerable to downgrades that could push them into junk status, after which financial institutions may no longer be able to hold them and could be forced to sell them off. We've seen a similar trend in loan markets, which have been traditionally, obviously, less tradable than bonds. This chart shows the rise in highly leveraged loans. That is, loans to companies that already have a lot of debt and they're already of high risk of default and so are below investment grade. Following a decline after the last crisis, the level of highly leveraged loans has now reached new highs. They are, by definition, much more affected by deteriorating economic conditions. The highly leveraged companies taking out these loans have lower cash reserves to withstand crises like the current one. And the most indebted industries represented in these figures are the most affected by the pandemic: consumer goods, energy, airlines, and manufacturing. In addition, these leverage loans have been packaged up into collateralized loan obligations, or CLOs, investment products that make these leveraged loans much easier to trade and sell between investors. As this chart shows, the use of CLOs to trade leveraged corporate loans has grown considerably, and they now are widely held by banks, insurers, pension and asset managers. Even retail investors who had to invest in riskier assets at a time when interest rates are so low. They also commonly have weaker investor protections than in the previous crises. In recent times, this level of debt has not been an issue because we've had good economic conditions and low interest rates, which means businesses are spending less of their earnings on servicing debt. And this chart shows how interest repayments have made up a smaller and smaller part of business expenses over the years, no matter what the investment rating. However, with the pandemic, economic activity has declined rapidly, and interest rates for businesses are going up as credit margins have widened significantly because of nervousness over the level and quality of existing debt. All these factors add up to potential for a vicious cycle. Defaults from a weaker economy could mean a downgrade in credit quality, which could trigger sell-offs, which could push up the cost of credit, causing further defaults as the cycle begins again. With the COVID-19 pandemic, we're already seeing a rise in the cost of corporate borrowing driven by wider credit margins, and the system is more prone to sell-offs today than the last financial crisis due to the rise in open-ended investment funds like exchange-traded funds. The way to arrest this vicious cycle is to stop these defaults, and this means getting cash and support to businesses who need it, and supporting households on whom these businesses rely. In designing relief packages, policymakers need to recognise that businesses may be facing both liquidity challenges from deteriorating credit conditions, that is, it will be harder for them to borrow money to cover short-term expenses, but also they may be facing solvency challenges from deteriorating economic conditions, that is, hard for them to pay their long and short-term obligations as they fall due, and both must be addressed. Policy institutions are facing a greater set of constraints in their response compared to 2008. Major central banks have already announced substantial responses, but with interest rates so low, many of them have limited room to manoeuvre. Central banks can continue to buy debt and other assets and undertake other quantitative easing activities to help inject liquidity and promote lending to business. There are examples on the screen. But these policies contributed to conditions that led to this huge build-up of debt to begin with. Governments and finance ministries are already engaged in a number of initiatives, including stimulus packages and programs for ailing businesses aimed at addressing the solvency challenge. These help, but the scale of aid needed is enormous, and many government budgets are already stretched. Government debt, like corporate debt, is currently very high, and programs must be designed in a way that avoids raising debt sustainability concerns for governments and making sure that taxpayers aren't on the hook for risky business behaviour. Financial regulatory authorities now have much better tools to deal with the banking crisis with reforms post-global financial crisis. However, as we've seen, the way credit is allocated and intermediated in the market is very different from 2008, and the effectiveness of those tools to deal with these new market structures is not clear. And while regulatory authorities are allowing banks to use more of their cash reserves to lend money, in the current environment, banks are likely to be very shy about making new loans to precarious borrowers. So governments need to be spending to help support economic activity and create a more favourable business environment. These constraints mean authorities must coordinate fully in their response to ensure that those responses are mutually reinforcing. As far as immediate responses go, governments and financial authorities should be looking to do three things. Firstly, getting cash to viable businesses by channeling equity, debt and guarantees to those affected businesses, including those below investment grade, and these programs need to have clear incentives to repay and clear path to exit to minimise government debt and, most importantly, taxpayer burden. And this could include hybrid options like equity warrants or mezzanine financing, which is a loan which can be converted to a stake in the business if that company defaults. Secondly, is providing financial support to businesses and households, including by encouraging banks to temporarily ease repayment terms for SMEs and households, or providing cash directly to consumers to address short-term cash flow challenges in managing household finances and promoting spending. These measures should be implemented quickly, efficiently, and avoiding bureaucratic obstacles. And thirdly is pursuing solutions at an international level. which means coordinating policy action between countries and temporarily sharing fiscal burdens, ensuring that any temporary flexibility in regulations and reporting doesn't lead to regulatory arbitrage. One key lesson from the last financial crisis in 2008 is that governments need to act early, go hard, and go fast in their responses. We cannot underestimate the impact that this will have on our economies, our businesses, and the lives of our citizens. If in doubt, governments, central banks, and other regulators should do more. The cost to governments of timely, ambitious action now will be dwarfed by the cost if we do too little or do it too late.